All right, so I think that's probably time to kick off. If you're here for Super 101 from CSC, you're in the right webinar. That's a good start. I'm Will. I'm one of the member education consultants at CSC, currently based in Canberra, joined by, as I said, my colleague Angela, who's based in Perth, and she'll be assisting with the Q&A. Now, I say Q&A, but in fact, if you could pop any questions you've got or any comments you've got about the presentation into the chat function, not the Q&A function. It'll be a lot more, runs a lot smoother from our end and easier to monitor and utilise. Certainly do encourage you to put questions in, make comments. We'll take it from there. Again, Ange will be monitoring that. I will probably be a bit tricky here. I'm just on one screen to sort of go back in, but towards the end, if we've still got a few outstanding and there's a nice heated debate about superannuation, we'll cover some of those key topics off, or some areas that perhaps we missed out that people might want to get in a little bit more detail. So before we get into a little bit any more housekeeping, just a couple of thumbs up that you can see that my screen sharing, you saw that title page, and now you can see the acknowledgement of country slide that's going up. Fabulous. And with that, I'll, on behalf of CSC, I'd like to acknowledge the traditional owners and custodians of country throughout Australia and their continuing connection to land, waters and the community. We here pay our respects to their elders past and present, and I'd like to extend that respect to all Aboriginal Torres Strait Islander people joining us today. Little bit of housekeeping, and we'll talk about first of these two. I won't go into detail, but look, the general advice warning, effectively, you'll see that when we're talking about financial advice, is that this information, although broadly is, will suit most people, will be relevant to you, giving you specific directions. We can't do that obviously in a group setting. So this is what we call general advice, the things that you can do, not necessarily telling you this is right for you, but certainly we can at the end talk about options that you might have to get either further general advice or stepping into that sort of personalised advice. And the target market determination, there's a link there. I won't go into too much, but effectively that's talking about the products that CSC offer, and in particular many of you will be PSAP members, and the suitability of the fund for you and your needs. We'll also, just in terms of this presentation, it is being recorded. So if anyone here, you get called away, or you've got a colleague who couldn't make it today, you can let them know it is being recorded, and we'll make those recordings available next week. So about this time next week. Unfortunately, we can't share the slides. That's just sort of a compliance thing, because information does change over time, and our compliance team gets a little bit funny when with the idea that there's some old slides out there giving false information. Also, there is a series of webinars. So if you do get to the end of this and go, wow, I want to do more, I'll get Ange to pop in the link. There is, I think, 3 or 4 other webinars, both superannuation, retirement focused, put on by the employer. All right. So what are we going to cover off? And again, agendas are really good. I'll try and stick to this as best I can. I sometimes can kind of weave and duck and dive, but effectively, really quickly, we'll talk about a little bit of background about CSC. I won't spend a lot of time on that. And really, this is Super 101. So what your super is, how it works, and for me, I kind of think, even though we've got 3 things there: contributions, investments, and insurance. We'll talk about very general and very high level what that is and why you might have them and how you can change them, but also what's it more around what might be right for you, or some of the things you can adjust to your superannuation depending on where you are in your career, whether you're starting out mid-career or approaching retirement. There'll be different times and different opportunities for you, but really with superannuation, I think it is often something that we don't get taught about in school. It's not something that we tend to have conversations at dinner parties or in the pub. I know when I'm being asked what I do, and I say I'm a super specialist or I work with CSC, eyes tend to glaze over, except for some of my friends who maybe getting close to that retirement age and want some free advice. So certainly superannuation is not the front and center, but the beauty of it is that you don't need to do a lot to make big differences, and particularly the earlier you make decisions or sort of adjustments, can have a long-term effect. Yesterday would have been better to make some changes, but today is better than tomorrow. So we've got the three areas: contributions, so putting money in; investments, what we do whilst the money's there. We'll talk about insurances and the importance of understanding what you may or may not have versus what you may or may not need. And the fourth one there that isn't listed is beneficiaries. So we'll talk about beneficiaries when we cover off the insurance bit. At the end, we'll cover off a few next action items that you can potentially take into your own hands. And there's a bit of a surprise right at the end, a real big announcement that CSC have moved into the digital influence space. And I'll cover off a bit more about that at the end. So who are CSC? Look, really simply, we are the fund that's been around. We've been around for 100 years. We provide the administration and the investment support for a number of funds across both public sector and defence, of which there are two open funds, the ADF Super on the defence side and the PSAP on the public sector side. So many of you will be PSAP members. For those that have a external fund, either retail or industry fund, a lot of this general information, although we'll be using the PSAP plan as the examples, all this information and advice would be relevant to you. If you're a PSS member, unless you have a PSAP ancillary, probably this is not the right presentation for you, but otherwise then you're in the right place. Take a sip. So what is super? So simply put, superannuation is, well, it's compulsory. It's a savings vehicle. It's a savings account that you're compulsorily contributing to when you work. So if you're employed at the APS, like you all are, that your employer contributes a percentage of your salary to go into your account, which provides an income, which primarily is an income for retirement. I've got a couple of quizzes, but I might just throw in a quiz and get people to put in the chat. And the question is, when can you retire in Australia? So if you've got access to the chat, have a go at that. When can you retire in Australia? First answer, pop it in and we can talk about that, what that means and how that is. But effectively, superannuation is a savings account that for most people, we use for funding our income in retirement, funding our retirement. There are other sources of income, but where superannuation plays a really crucial role, we'll get into that a little bit more, what its advantages has versus some maybe some things, the disadvantages, and a bit of a spoiler here. We're going to talk about tax. So really that is the key to superannuation and why it is important, and how we can utilise it effectively as a savings vehicle. So typically we think about superannuation as something that we can access down the track. Again, let's hopefully a few of you answered, when can we retire in Australia? If anyone picked up on my language, it was a trick question. We can retire in Australia whenever you want to, but realistically, more likely, it's whenever you can afford to. So typically, I'm sure there's some of us, maybe not every day, but there are days where we all think, geez, I'd like to pack it up and retire, move to Queensland or somewhere nice and sunny, or if you're a Winter Olympics fan, maybe somewhere nice with lots of snow. But yeah, really it's affordability. So I guess the more pertinent or the more direct question would have been, when can we access our superannuation? Which is really when most of us start thinking about retirement. And if you're an accumulation member, and by that I mean if you're a PSAP member or if you have a regular fund, industry fund like UniSuper or one of the bank super funds, the earliest where you can access our superannuation is 60. Okay, so 60 is the preservation age for anyone coming through today, and that is the earliest in which we can start accessing our super. There are some conditions of release, primarily that you're not working at the time in which you want to access your super, but from 60 onwards, this becomes available to us. If you've got any colleagues or friends in the old PSS plan, one of the advantages there is that they can start accessing some of their super from 55 if they've retired. For those that put 65, look, 65 is a typical retirement age. It does play a role in superannuation. The condition of release to be retired ceases. So if people are working through to 65 or at 65, their superannuation will become available to them whether they're working or not. And if there's any in there that said 67, 67 is when the government age pension comes online. So it is means tested. It is still there. Certainly relying on it wholly and solely would be a very modest retirement. But for a lot of people, it provides a bit of a safety net, and they might be able to access it if they meet the means tests from 67 at the very earliest. So that's kind of the retirement question. Whilst still working though, your superannuation, you can use it for one purpose, and that is protecting your financial security from things like injury, illness or death. So we're just probably just protect it from death, but it certainly provide a financial safety net for your family and those loved ones left behind if that situation was to occur. And that's through the insurances, which we'll cover off as well today. All right, so it's quite simply, I won't go into this too much. Your financial well-being, how does superannuation work? Well, at the moment, your employer is required to put in a compulsory level of super. Again, there's a quiz. I won't pop it up there, but the question was, how much is your employer putting into your super? And for members of the APS, that contribution rate is 15.4% of your salary. So depending on where you are in your career, and typically earlier on, we don't think about our superannuation a lot because retirement is, 30 or even 40 years away for some of us. It can be this sort of intangible thing that we just don't understand or don't pay any attention to. But 15.4% on top of your salary that you're getting paid goes into your super account. So that's what we call your super guarantee contributions. That's guaranteed, SG. So that goes into your super fund. So effectively every second Thursday you get paid, your pay goes into your bank account after tax, and it gets taxed at the marginal tax rate. And again, I promised you that we talk about tax, but for anyone, earning between about above $40,000, your marginal tax rate. So as we earn more, the tax rates go up. But from about $45,000, the tax rate is 30%, and it goes up after 135,000 to 37%. And then if you're in that higher bracket, people earning over $190,000 a year, they get taxed 47 cents in every dollar. So certainly tax will play a role because that gets paid. You've got that fortnightly pay going into your bank account, and that's funding your lifestyle now, maybe saving for short-term or medium-term goals, short-term goals like a holiday at the end of the year. Maybe you're saving for for a property or to purchase a car, whatever these things are. That's what you've got there. Your super is automatically put into your super account, in which that 15.4% goes into your account. It is taxed inside super, but it's taxed at what we call the concessional tax rate, and that's 15%. So already, and really, this is where I promised you about tax. The big advantage of superannuation is particularly for your employed contributions, and we'll talk about the difference between pre-tax and after tax, is that it goes in, it is taxed at a lower rate of 15%. For the majority of us, our marginal tax rate is at least twice that. So, you've got less tax coming out, going into being saved and invested. So effectively, that's how it is. So once it's inside your super, we've got things like tailoring your insurance, your investments, and then we can talk about what other options you have in terms of contributions. So let's start with contributions. We talk about 15.4%. The actual stipulated minimum that employers in Australia today have to contribute is only 12%. So the fact that you're getting, at the moment, another 3.5% nearly on top of people in the private sector can really make a huge impact, particularly over the long run. The eighth wonder of the world, known as compounding interest, is the fact that those extra contributions, the more you're putting in, you're getting those extra money, getting investment returns and growing. And you can see here a very kind of basic example over a 35-year period. It can make a significant difference, even if we're on, a salary of 75,000 and we're investing in a fairly sort of balanced investment option. 15.4%. It is 12% is the minimum in Australia. It wasn't until recently. Well, it only started 12%. Only went to 12%. 1 July last year. So this financial year is the first one, and it wasn't that long ago that it was at 9%, and it slowly has crept up through sort of various government decisions and going between the two parties. One likes, one doesn't. But effectively we got to 12%. But for a lot of people, particularly if you're in your late 30s, 40s, 50s, 60s, a lot of your friends who are in the private sector, they might have been getting even less than that. So it does make a huge difference over time. And one of the things you can do, if we can, Angel, pop up, there's a retirement modeler calculator. You can play around with that if you're really interested, but it really does make a huge impact. So it's the secret of super, but it's not really rocket science. Is the more you contribute, the more you're going to have in retirement. And that's the same goes with any savings. More you save, the more you've got when you get to your goal. Right. Contributions. Two types of contributions we talk about. We talk about concessional contributions and we talk about non-concessional. So I'll explain what that is and some of your options that you have there. Your concessional contributions are before tax. So we refer to concessional because they're put into your account and taxed inside of super, not from your pay, which is taxed at the marginal income tax rates, and then you can perhaps save that or contribute that to your super. Before tax contributions get taxed at that concessional rate of 15%. What this makes up is, as we've talked about, is your employed contributions. For you, 15.4% is going in there and getting that concessional tax rate. You do have the option to take advantage of this concessional tax rate by making voluntary contributions. And there's either as a regular payment through what we call salary sacrificing. There's something, it's as easy as going to your payroll and saying, hey, look, I want to put in, $100 a fortnight as a salary sacrifice contribution, and that $100, is siphoned off in addition to your employee contributions into your super fund, which is then taxed and invested and there for growth for your retirement. So you can do that. The other one is people make voluntary contributions, and then in the new tax year, whilst they're doing their tax return, they can claim the difference between the tax rate that they paid on it through their salary and the lower tax rate. So there are two different ways. And certainly if you've got more questions about that, or you're thinking about the differences or what's the best option for you, as I said, it really comes down to you and the way you operate. For a lot of people, and again, general information, the salary sacrifice mechanism is a great way to start out because it's done. You won't, it's taken out. It's out. You don't even miss it. It's out of your pay packet, and you can it's a regular savings vehicle which you can increase, decrease, cancel at any time. So these sort of your concessional contributions. There is a caveat there, or there is a limit on how much we can put into our super, and that is concessional contributions at the moment. The maximum between what our employer puts in and what we put in total has to be at least no more than $30,000 per year. So for some people, they might be, particularly on higher incomes, they might be getting close to that 30,000 as it is from their employed contributions. For others, you might have a lot more space in that cap and take advantage of that. It's capped out. Really, the thinking behind that is to sort of limit further advantages that higher income earners have by their ability to take advantage of these concessions. 30,000 per year. It may go up. It usually goes up every few years to sort of keep track with the fact that inflation increases or CPI increases our salaries, whether you think that or not. But that may change and go up to say 32,500 in the next year or two. But ultimately, at the moment, 30,000 is the cap. If you're someone going, hey, it's not a lot left in my cap space, but I really want to get. I've got some money. I really want to hit this hard. We've got another provision which allows us, if we've got less than $500,000 inside of our super in total, we can use unused cap space from the previous 5 financial years. So if you've put in, let's say, 20,000 each year and you've got 10,000 unused cap space, you'll be able to carry those 5 lots of 10 across. And so for a lot of us, even though 30,000 is the annual cap, we may actually have more in space in our ability to make those concessional pre-tax contributions. To check how much space you've got in your contribution cap, you can do that through your MyGov website. So logging into there, going into the ATO section, there is a superannuation drop down, and unused cap space is one of the options, and you can check that out. And for those people that are really kind of thinking, I'd like to hit my super pretty hard right now, that could be a really important thing to understand where you fit in that. If you need some general advice around what's right for you or where you should start, at the end we'll flash up some details about some more sort of one-to-one conversations you can have with someone at CSC. All right, the other type of contributions, after tax or non-concessional. These are voluntary one-off contributions, typically from people. An example might be someone's inherited some money and they want to put some extra money inside super. They've received that money. It's either was tax-free or it had some tax associated with it. But when they put into their super, it's an after-tax contribution, so it doesn't get taxed again, and it's additional ability to boost your super. Yes, now, again, there's no right or wrong, but generally speaking, if we're talking about contributions whilst we're working or trying to reduce our taxable income, the concessional contributions are really important. But beyond that, the non-concessional contributions are another great way to get money into your super fund, invested, taking advantage of the low tax environment with investments. And then the really important thing when tax, the most exciting bit about tax is after 60, when we start accessing our superannuation, it becomes tax-free to us. So it's all tax-free after 60. So that's the beauty of it. We either pay it through those concessional contributions or it's been taxed already, non-concessional. And then when we get it after 60, there's no further tax pay. So there are your two types of contributions. Your non-concessional does have a cap. At the moment, that cap annually is $120,000. So really that cap is really only going to apply to people that have a large amount of money, as I said, from an inheritance or the sale of property, or they won Tats Lotto or had a hot tip in the races at Randwick, and you can put that in. 120,000 is the cap there, and even for some people, we can use what's referred to as the bring forward provision, which actually allows people to bring in 3 years into the future into that year, which at the moment would be in one hit $360,000. So again, if any of that is sort of kind of thing, I'd like to know more information, or I'm thinking about this, I don't know where I start or what option's best for me. We'll talk about some options who you can speak to from CSC when we finish up. If there's any questions that are popping into the chat, I'm sure Ange is tackling those as well, and fantastic. Superannuation, concessional contributions, non-concessional contributions. I think that's probably enough on that topic. So let's jump into, I probably should have used this little example here. The advantage of the concessional contributions is, again, taxation. So that example, I'm going to start with $100 a fortnight. I'm going to redirect that $100 a fortnight into my super. Now, that $100 is the pre-tax amount. At the moment, if I'm on the tax rate of 30%, really what I'm sacrificing is $70 in my pay packet or on my bank account for that fortnight. Pay packet, that's an old term, in my bank account. But if I redirect that $100, because it is only taxed at 15%, by sacrificing $70 now, I'll have $85 invested in my super. Really important to understand, though, it is great, and it's certainly these concessional tax rates are effective and a really great way to save. But the trade-off is obviously any money that goes into my super, I can't access until I'm at least 60. There is one exception there, and that is for people who are considered first home buyers, and that's the first home buyer super saver scheme. If there's anyone who really wants to hear about that, I suggest put your thumbs up. And if there's enough people that want to cover that off, we can talk about that perhaps at the end of the session, and people who aren't interested in that can jump off the call because it's really only relevant for people that are first home, saving for a first home. And it's the one way in which we can potentially access our super other than compassionate or financial hardship reasons, where we can access some of our super before we turn 60. Again, I'll cover a bit more information about that at the end. Saw a couple of little thumbs up, and we'll go from there. All right, let's move along to investment. So we're collecting all this money. There's 15.4% of your salary going in each fortnight. That money is then, what we're going to do with that. CSC and all super funds will then find a suitable investment option. You would need to choose that suitable investment option, but we would invest that on your behalf and look at how we grow that further through returns. With the PSAP, we have 4 investment choices. Again, this is probably the bit where it's really sort of focused on PSAP. If you're a choice member, if you've got another super fund, all these kind of concepts will be relevant. They'll have maybe different investment choices. They might have more, they might have different names, but overall, the general information will be relevant. So you have the ability to tailor your superannuation investment choice to your liking. And a lot of what those decisions will be is looking at risk versus return. So that's a term we use a lot inside super, risk versus return. The higher returns typically come from growth assets, things like shares, property, some infrastructure projects that potentially have higher returns. But if we think about the stock market, even if you not really follow it or you don't have any interest in finance, you might have an understanding that share prices can go up and down, and on any given day, some companies can have really good days, others, they can be kaputs. So we have growth assets, and then on the other end of that, we have what we call defensive assets. So they're more kind of steady as she goes type of investments. They're designed for security and safety over potential upside returns. Things like having cash in the bank, which you can have that wholly and solely inside your PSAP, and in fact most funds offer cash. But there are other defensive investment options, things like fixed interest and investments. A term deposit, that's an example of a defensive investment option. You'll get a rate of return, depending on where the interest rates are, but it'll typically be set. And we know that if it's set at, let's call it 5%, that's sort of what we're looking at over the next 12 months, as opposed to investing your money in the stock market. We could get a 20% return or higher, or we could certainly even get a negative return. So defensive investment options and growth investment options both have important roles to play. Our investment choices from the left of the screen go from the most defensive to the most growth focused or aggressive. It's even called that. Cash, 100% cash, income focused, has a blend. And it's really important, these next 3, these managed funds, they're all diversified and they'll have a mix of all these investment choices. And diversification is a really important component of how we invest your money. And in fact, most super funds do, because by not putting all your eggs in one basket, by spreading the risk across a number of asset classes, and even in those asset classes, a number of different investment choices, we sort of minimize the risk that, let's say in the stock market, we might see, I don't know, what's a company, I've got my phone there, Apple, Apple might one year have a 30% return, but then the following year the iPhone isn't popular or something happens within their business structure, and all of a sudden, their share price tanks. And if we had all our money inside one share, the upside could potentially be really good, but the downside, particularly when we're talking about our retirement savings, is that there's not going to be enough there when we want to retire. So spreading that risk. So even though aggressive has around about 90% of its investment choices in those growth assets, there is still the 10% component, which is defensive, that's a CSC philosophy where, we've designed it that way so that, even though perhaps that's a really good year for those markets, CSC compared to its peers may be, not quite at the top of the list. In fact, because it's only sort of really seeing 90% of the upside. The philosophy or the design of that is that in the downturns, it softens the impact. And in fact, over the long run, in sort of negative years, we've been sort of 25% or higher better off than perhaps some of our peers that are all 100% wholly and solely in those growth assets. So diversification, really important. But you as an individual, you need to decide what's right for you within the choices you have. And that can change over time. And time is probably one of the most important, crucial factors when we're making the right selection for investments. Generally speaking, growth is a long-term investment, long-term prosperity, but there's going to be some short-term volatility. So volatility in the marketplace, it's designed that way. That's how it works. And that's why there is those potential upsides, because people are prepared to take that risk. Something like the aggressive fund, there's a chance once every 7 or so years of a negative return. Okay, so if you're perhaps, a very rudimentary example, if you're approaching retirement in the next 5 to 7 years, ask yourself the question, what would happen to you, or how would it impact your retirement if just before you were going to retire, the markets had a massive, massive downturn? So time in the market is more important than trying to time the market. And you, as the individual, your risk profile is also really important. So generally speaking, if we've got a long-term investment, being more growth oriented is sort of the general idea. And perhaps if we have shorter term investment time horizons, something in like the more defensive, like the income focused, or a blend of income focused and balanced or cash, could be right for you. The balance, if you don't know which one you're in, you will be defaulted into the MySuper Balanced. All super funds have to provide an option like this, and it's sort of a general cover, the majority, although because until someone tells us which one they want to be in, we have to kind of put you into something. So the balance is about 70-30 in terms of blends between defensive and growth assets, and the income focused is sort of the other way around, sort of around about 30% for growth, with 70% built in for defensiveness. And in that case, it's defensive, but 30%, we still want to get some returns. Even in retirement, you want to see potentially some growth in your nest egg, so that as you're drawing on it, over the long run, it doesn't run out before you do. Okay, so with all that said, I should bring up a little graph, and as I said, the quiz would have been which one of those four has been the best performing fund over the last sort of 7 or 8 years, depending on what you think. But I've jumped onto the next slide anyway. So the answer there is the aggressive fund has outperformed the balanced fund, which has outperformed the income focus, which has outperformed cash. You might notice something there, which I notice, is that the three managed fund lines all have a similar kind of look and feel about them. And that's by design, and because they are effectively, in many cases, invested in the same underlying assets. It's just that the income focus has more of the defensive assets than the balance and the aggressive, and vice versa. The cash is typically a straight line. It's designed, and cash, the cash rate goes up and down, but really only by, 1% here or there. And you won't see any negative returns from cash, but what you won't see is any sort of particularly great growth over the long term. So which one's better? Yeah, well, I mean, if we could go back to 2017 and the crystal ball, and we knew we could, well, 1, we could do that. 2, we had the crystal ball, and 3, we didn't need our super until at least today. We'd say, well, the aggressive fund was the better fund. That's the right fund. That's the right choice. I should be in that. It's 1, we don't have the crystal ball. 2, not everyone necessarily is still working at this period. If we think about where we were in 2017, no one knew. We had 10 years prior, or 12 years prior, the global financial crisis. Some of you may not remember, many of you will, the GFC. I don't think I've got that graph here, but what the graph, if I did, would show that the downturn there was significant. And in fact, the aggressive fund took about 5 years to recover to just to where it was pre-GFC. The income focused recovered quicker because it didn't dip as much, and then the balance, yeah, you guessed it, somewhere in the middle. So not knowing what's coming in the future, we need to sort of plan what's right for us. Because if I'm 2017 and I've just started work, I'm 22 years old and I've just joined the public service, and I'm going to work through to at least 60, whether there was a hit during the US-China trade war, or when COVID hit, or any other Ukraine conflict, and then if we look at sort of things like trade wars again, dot-com bubbles, whatever it's going to occur, the nature of the market is that there is volatility in it. There are ups and downs. But if I've got time in the market, then I've probably got some more ability to absorb downturns. But if I'm sitting here just before COVID, or if we go back to the GFC, and if I was planning to retire in the next 12 months before the GFC hit, and I was in the aggressive fund, and all of a sudden my fund dropped by 25%, that is a huge impact, because these wins and losses are only on paper until the point at which we go to access that money. So if I'm starting to draw down on my super, and it's at a lower, it's lost 25% of its value, as soon as I start taking that money out, I've crystallized, we use that term, crystallized losses. Okay, they become real once we convert that in and we spend the money, and those losses don't have the ability to recover. So where you are, we don't know what's ahead of us. We can only plan for the worst, and hope for the best and plan for the worst. So understanding where you are in terms of your investment life cycle, that may be 60 for some of you. You might not be retiring at 60. You might not be work past 60 for other, and you might not be too worried, or you might have other investments elsewhere. Super is just one part of your overall nest egg. But for many people, and going back to the GFC, if you lost 20 to 25% of your balance, and that balance was just sort of was going to be enough to draw an income, pay off the mortgage, buy the caravan, all these things, or certain parts of it. For a lot of people, they had to make real decisions, and for many people, it delayed retirement. You might know someone that was in a situation like that. So certainly, understanding that and where you are in your, investment timeline might be the guiding light between which ones are right for you. If you want to sort of have a little bit of a guide, though, we do provide a risk profile quiz on our website. Angie's going to pop that up now. It's just a series, I think it's 5 or 6 questions asking you sort of how you feel when you're looking to retire, these sorts of questions, and it might spit out an answer that is appropriate to you. You can make changes to your investment option as you like. You do that online through the navigator, so log into your account online and you can make the switch there. Just be sure you're making the switch for both current strategy and future strategy. They're terms we use for basically current strategy is the money you've got, future strategy is the money you're about to put in. And you can make those switches there. You can blend. So for some people, they might go, for example, they're in the balance fund. They think I want to be more than that. They can go all in the aggressive fund, or they can have, say, half balance and half aggressive fund, which sort of brings that blend in between. So you can blend those, and don't do too many, because I've seen ones where people put a little bit of everything and really it adds up to being effectively, say, the balanced or the income focused option. But you certainly have some control over that. Again, our super specialist, which I will give information at the end, can give you some general advice, guidance on that if you like. The last thing I will say about volatility, well, there's 2 things. One is typically, and I remember 2020 working for a different super fund, but helping out and speaking to a lot of members who were wanting to get out and take all their money out of balanced or aggressive options into cash. And a lot of people did that, and typically people did it after the fact. So when not here, but here, when the market crashed, and then they stayed in the flat line for a while, or a lower line, and you can start, it recovered pretty quickly, and then their super was impacted by making those reactive investment choices. So volatility is part of the strategy. If you're making a switch, or you're wanting to make a switch to your investment choice, particularly if you're going from something into something slightly more high growth focused, remember it really should be a decision you're making for the long term. Okay, you assess it over time, but typically, for example, if you're going from 25, I'm in the balance fund, I think I'm going to go in the aggressive fund. If you're making that decision, that's just an example. Make sure you understand that probably it is a bit of a set and forget for at least sort of 5 to 7 years before you're even looking at changing that. And the downturns, whilst you're contributing, can actually be it is part of the strategy. It is part of the process. So thinking about, prices of stuff, You know, if all of a sudden, if you think you're walking past I don't know, a shoe shop and you see a pair of sneakers you like and they're $200 one day, and then the next day you come back and they're on sale for $100, you know, your $200, the value of your $200 has gone up. You could buy 2 sets of sneakers. Now, offloading those is a whole other thing. I'm told there is a resale market, but in effect, whilst you're contributing, i.e. when you're working and you're putting money into your super every 2 weeks, if there is a downturn in your investment choice, that means the unit price of that fund. So a unit price is the value, you know, of that particular fund. It's like a share price. If that goes down, then your purchasing power goes up in effect, and then that kind of what we call dollar cost averaging over the long term can be, you know, an effective way to see that you're actually getting a much higher return than just what the fund is saying for that particular day. All right, I think that's enough for investments. Kind of covered that off. Risk considerations. So if you are making choices, again, for us, or if you've got your own choice fund, there are different investment options. Think about your investment time frame, what your personal appetite for risk is, and there's no right or wrong. If you're in your 30s, but it keeps you up at night, the idea of being in an aggressive investment option, you know, if you're losing sleep over it, that is often one indication that maybe that's not the right choice for you. But for many of us, it's a set and forget and a long-term investment. You know, go for it. Do that risk profile and then talk to one of our super specialists, which we'll cover up at the end. All right. Now, they're kind of the main thing. So how do we, it really is about, most of us, how do I maximize my super? Well, how much you put money in and then you invest it for returns. So find a suitable level of contributions that you can make. And if that's just where your employer is at the moment, great. If you've got capacity to save, even if it's a small amount for a short period, putting those extra contributions in, compounding through the investment returns that you're receiving. So getting contributions in, investing it appropriately. That's how we build our super and our retirement nest egg. But that's to say, in a perfect world, for many people, you know, there are unknown events that can hit, or unexpected life events that can hit, and that's where insurance comes into play. So when we talk about insurance within your super, we've got three insurance options, three insurances that you can hold. Now, you can hold these three outside of super, and there are many more options outside of super, but inside your super, the one thing other that you can actually use your super for is to pay for the premium for these insurance options. So life insurance, better known as death cover, i.e. a lump sum that would be paid to your beneficiaries should you pass away, and that life insurance plus what you've accumulated in your super, you know, would go to your family, and you know, and really important, you know, what's the financial situation that you would leave your, let's say, partner or children or someone who's financially dependent on you. You know, what would you need to leave, or what would be the impact of your death? Temporary or permanent disablement. So we have lump sum amounts like death and what we call TPD, total and permanent disability. And then there's also the third type, which we will cover off, which is covers you for temporary sickness, illness, or injury. So these are really important. These are personal insurances. These are different. These aren't like health insurance or anything else. This is insuring your main asset, which isn't your house, which isn't your super. It's your capacity to earn an income for the next 10, 20, 30, 40 years. So three types of cover. I'll go in reverse. So death cover, that's a lump sum that's provided to your nominated beneficiary and payable, also payable if you've been deemed terminally ill. And that insurance plus the super balance goes as a lump sum, and that's there to, you know, things like, you know, paying off mortgage or for kids' schooling, or just, you know, a gift, knowing that you'd otherwise not be able to support them financially through the years. TPD, that's a lump sum that's often grouped with death cover. TPD, total and permanent disability. So this is in a situation where you've been injured, or your illness means that you're never going to go back to work, or highly unlikely to ever go back to work, which is a horrible situation. So it's a lump sum paid out to you, your insurance and your super, to support you and your family to get through life, not ever being able to go back to work and earn a full-time income. So really, really serious, but that's where that we can use this superannuation to pay for this. The third one, and look, I haven't got the stats on top of my head, but the most commonly claimed one through working career is the income protection. So that's an insurance that is designed to replace a proportion of your income should you find yourself off work for a long extended period of time. Now, this is covering you, yes, what about Comcare or work cover, these types of things? Yes, they're great if you've had a workplace related injury or illness. But if you're like one of our colleagues who loves his mountain bike and he's in his well into his 40s and he's doing things that he probably maybe shouldn't be, if he come off his bike and broke his leg and couldn't get to the computer and couldn't work for 6 months, what's going to happen to his ability to pay his bills, his mortgage, look after his family? This is where income protection comes in. So it's designed to replace a percentage of your salary for a period of time. And there's 3 components of which income protection you need to be aware of. That's the level of cover. And typically policies start with 75%, replacing 75% of your salary. You won't be able to replace 100%. It's I suppose that it's been designed that trying to incentivize people to go back to work. So it is not quite enough to replace all your income. And you certainly can't insure yourself for more than 100% of what you're earning. So percentage of your income, which is 75%, but with your PSAP, we also will include ongoing SG contributions of 15.4%. So effectively you're getting 90.4% of your salary paid whilst you're off work. Our benefit periods, which that's the length, the maximum time, so there is caps to this, is typically between 2 and 5 years. And then the waiting period is the third element that you need to be aware of, and that's the minimum amount of time you need to be off work before this policy can kick in. And you can adapt that. Typically there's 30, 60 and 90-day wait periods. Why would you choose 90 over 30? Well, generally speaking, the longer the wait period and the shorter the benefit period will reduce those premiums, because your premiums are just a reflection of the likelihood or the chance of taking a claim. So you can, so it's really important to understand that if you're a PSAP member, you will automatically receive all 3 forms of these insurances. Other super funds, they will all provide some level of death and TPD. Some provide a level of income protection, others don't necessarily. You would need to check with them if you are a choice member. But if you are a PSAP member and you didn't know and you haven't done anything about it, you will have all 3 levels of cover. The exception to that is if you're under 25 or your super balance is less than $6,000. So if you're under 25 or you haven't rolled your money, you've just started out, then you won't get that automatic level of cover until you either hit one of those markers or both of those markers. Not to say you have to have insurance or you can't get it if you're under 25 or don't have the balance over $6,000. But for those people that are over 25 and have a balance higher than 6,000, it would be an opt-out situation. So if you don't want the level of cover, you can go into your account and cancel that, or call CSC and cancel it. If you are under 25 or you've got less than $6,000, you would need to opt in. So certainly you're able to get it, but it was designed that way, generally speaking, because across the board, there's less demand perhaps for people under 25 or have low balances, so the premiums aren't chewing up your balance. Now, there's an automatic level of cover. You can check that out. PSAP is one of the highest across the industry in terms of what we call group cover, i.e. how much the insurance company's prepared to give you as a group before they then need to start finding out a bit more about you. If you need more life cover, you might look at it and say, I've only got, that won't be enough to cover off my mortgage and put my kids through school. You can apply for increased levels of cover. But at that point, that's when the insurance companies want to start knowing a bit more about you, what your health looks like, do you have any pre-existing conditions, any family history, this type of stuff. Your insurance needs change over time. As your mortgage gets paid off, for example, and your super balance increases, you might want to review. You might not have enough insurance, but you may also potentially have too much insurance, and you'll be paying a premium on all this cover. So it's certainly worthwhile. One of your bits of homework is just to check your level of cover and determine whether you think that's right or wrong. If you want some further information or some assistance, again, I've spruiked the super specialist at the end. That's the general advice service that we provide complimentary to all PSAP members. But we also have a calculator, a life insurance calculator, that could be a good starting point. It can build in some assumptions, and you can add some information, and it can give you a bit of a readout, and it can calculate perhaps for you how much is enough in terms of life and TPD insurance in particular. And then you can review that and see that's great premium, and you've got to weigh up also the cost of that cover. So it's a really good one. I know Ange will pop that into the chat if she hasn't already. With income protection, great thing about that, it is automatic. You get that full 75% plus the SG payments. You'll get defaulted into that, and you'll get it'll default to a 90-day waiting period and the 2-year benefit period, with going through to 5 years with a reduced level of cover. The percentage is based on the information reported to us from your employer. So as your salary goes up, that will adjust accordingly. Be aware that the premiums go up when your insurance covers go up, but also as we get older, because again, the likelihood of a claim statistically goes up as we get older, and particularly death cover, there's inevitability there at some point. So be aware of all of that, but that's all in there. If you think 90 days, I couldn't last 3 months without my income, then again, you can go in, you can apply for an increased or you're bringing in your waiting period or change your benefit period. That will impact the premium, but certainly worthwhile considering. So we're pretty much through that. And really the fourth one, which isn't here, I need a slide, but is beneficiaries. I've mentioned beneficiaries a couple of times. Oh, and there's a QR link for the Life app calculator if you haven't already seen the link in the chat. Your beneficiary. So who gets your money if you were to pass away? And I've mentioned beneficiary a couple of times. So really important, very quickly, when someone passes away, your superannuation is treated separate to the rest of your estate. Now, if you've got a will in place, that makes things nice and easy for your family and understanding where it goes, and they can fight over it if they want. But as long as you've got some will in place, it typically goes where it should go. Your superannuation generally is treated differently because it's held in trust. So it's important to understand that if you want to streamline or make the easiest time for your loved ones should you pass away, really important to nominate a beneficiary for your superannuation. There are 2 types of beneficiaries. We have non-binding beneficiary, binding beneficiary. Binding beneficiary is legally binding. It's probably the strongest level of beneficiary nomination you can have. There are some conditions around that. You can only nominate what from a legal standpoint is being deemed a financial dependent. And that can only be one of these people, your spouse and or children. In some cases, if someone's financially interdependent on you, so if you're a carer for someone, they could potentially be one, so financially independent. Or if you have a will in place and you want it to go into your estate, you can nominate your estate through your legal personal representative. On our form, it's the LPR. So anyone outside of that, you won't be able to nominate as a binding beneficiary. If you don't have any of that, you can nominate a preferred beneficiary or a non-binding beneficiary. But in the example where someone might nominate, I'm going to nominate my brother, but you have a spouse, that the superannuation trustee, can actually legally have to overrule that, and the money would be passed on to the spouse. You can nominate binding beneficiary, but you can find that there's a form. You need to print that form off, sign it, have it witnessed and signed by 2 people, and return that to us because it is a legally binding document. We're still on paper for that one for the time being. And it needs to be updated every 3 years, just to protect members in case their situation changes, and a reminder. You can nominate a non-binding in the meantime, or if you don't have any of those financial dependents, you can nominate, say, I want my father to have it, not my mother, or my sister and not my brother, or however you want your family to sort of fight over your leftovers. So they're really good. If someone passes away without a beneficiary nomination, and you have a spouse and children, typically the superannuation trustee will get to that. It's just the process in which your family has to go through in terms of the paperwork and the stress. We'd always say a really simple thing you can do if you're concerned at all about your family is to get that binding nomination in place and go from there. A will, really good thing to do as well, but we won't cover that off today. That's pretty much it. Oh, there's us. We won a few awards. I don't know how that one got there. But look, PSAP, really good fund, designed for public service and office workers, and has a really strong long-term focus in mind. Next steps, right? Get onto your account online, have a look at those things around, is my investment option right for me? You can choose one, review your insurance, and we didn't talk about it, but combining your super. So if you've only recently joined the public service, or you've had a career outside of public service, you may have some other super out there. For most people, having one fund is enough, and there's some really good reasons to have one fund, ease of management, etc. Some people choose to have a couple of super funds. It might be insurance. I've got my insurance here, but I contribute to this one. But potentially, if you've had a few little jobs through your career and you've kind of lost track of where some of your super is, there's still billions of dollars out there in lost super, and often it's sitting with the ATO, earning no interest, and sort of you might have some money in there that is worthwhile doing. You can do a super search through our website, or you can do it through your MyGov. Really important thing to do. And the other one, we talked about contributions. What's the advantage of putting extra into your super? Well, it's a tax-effective way to boost your savings for retirement. Super specialists, they're the people that you can have a chat to. For our PSAP members, you have the ability to speak to them over the phone. It's typically it's a half an hour appointment. It's general advice only, but they can kind of give you quite a bit of guidance around any of the stuff we've covered off. So it's general advice. There's no cost to that. It's part of the service we provide to our members. And if you really, I suppose if you haven't spoken to someone you'd like to, really important to take advantage of that service. We do provide different higher levels of personal super, so intra-fund or comprehensive insurance, comprehensive personal advice. That can be there. Particularly for the full service, there may be a fee for service for that. But for many of us, starting and having a chat with super specialists could be the first step to kind of your retirement planning. Last but certainly not least, and thank you for everyone that's stuck around, CSC now has a Instagram page. So CSC_super education, where Ange, my colleague there, she can give a wave, she's screens off, has been working very hard on. There's a lot of great information here, super tips, tidbits, a lot of information that you can get here. This has been an hour, it's been pretty intense, I appreciate that. But kind of little bits and pieces. So I really encourage you. In fact, if at least 5 of you sign up, then Ange, I get an ice cream or something. I think, Ange, next time we're in Canberra. But certainly check that out. It's a really bit of fun, and just short TikToks type videos. Mostly we can't use TikTok, being part of the federal government, as you may well know, but it's a really good starting point, and encourage you and any of your friends to check it out, have a look, and you might even catch up with Angie's mum, who I believe is our #1 fan. So thank you everyone for dialing in today. I can feel free. Thank you for everyone for dialing in. I'm going to just check in on the questions. I can talk a little bit about first home buyer super saver scheme now. If anyone wants to stick around, stick your thumbs up if you still want that. Otherwise, enjoy the rest of your afternoon. Oh yeah, there's other stuff. Of course, Ange, there's lots of great information on that Instagram. It's highly worth joining. So if anyone anyone wants to get further information about first home buyer saver scheme, maybe just put a yes in the chat or something. How simple is it to nominate a beneficiary? Look, really simple. There's a form. If it's binding, you just fill in your details and say who that person is, or if there's children, 50-50, or you might want to split it differently, you can do that. Non-binding you can do online. But the binding, you would need to have the form print off. So that's probably the main barrier. But otherwise, yeah, it's a fairly simple process. All right. Thanks, Mary. The link is for the forms. It's the CSC website, and you can log into your navigator online. Yep, csc.gov.au. All right. Well, I think most people have jumped off now. So for those who want to know a little bit more about the first home buyers, so taking it back, and it is 3 o'clock, I'll try and keep this brief. For many years, the political football that is super, one of the things a lot of people feel we should be able to do is to access our super to help with home affordability. You know, I have a view on that. I disagree, but certain superannuation should be for retirement. But you know, through the various sort of government changes, etc., you know, probably 7 or 8 years ago now, I can't even tell them, might have been the Liberal government, doesn't really matter who it was, came up with this first home buyer super saver scheme. And in effect, it was it was designed to be a way to access your superannuation to help pay for a deposit on a first home. It's probably not what most people hoped or thought it would be, but it is a way to take advantage of those concessional tax rates for savings. So basically, you can access some of your super to pull that out before 60 to put it as part of your deposit saving. However, it's only any voluntary contributions that an individual makes. So any employee contributions, untouchable still. If someone is making, say, salary sacrifice concessional contributions, they can potentially, when they go to purchase a first home, they would be able to draw that back out. There are limitations. Overall, an individual can't access more than $50,000 worth of contributions, and any given year, $15,000 is the max you can put in. So, you know, if you could afford to do it, 15,000, it would take at least 4 financial years before you max that out. For most people doing it, yeah, it's got to be longer than that. What you can access, you know, but the thing is, if you think about 50,000, the difference between your marginal tax rates is 15% for most people. So you would have an extra, if you did the full amount, you'd have an extra $7,500 at least go towards your first home deposit. Not going to make a huge difference. It's not going to move you from, I don't know, I won't insult anyone, but, you know, outer suburbs to inner suburbs, you know, or a 2-bedroom to a 4-5-bedroom house. But $7,500 isn't to be sneezed at, particularly for someone that is at the start of their savings vehicle. You know, it's a good opportunity to put some money away. It's locked away. You can't get it out. You know, you can't be tempted to, you know, spend it on a holiday to Bali, what have you. So it's a good savings vehicle. You can access it. If you're saving with a partner who is also qualifies as a first home buyer, that 50,000 then becomes 100,000, which, you know, from a tax savings perspective, that's $15,000 better off. So all of a sudden, if you think of it that way, that can be a really can be a big difference. The 50,000, and Anne just put a link in there. So there's a lot of information which I'll try not to get into, but regardless of whether the markets have gone up and down, you've still got access to that 450 plus some interest that is deemed to have earned at kind of a, you know, a CPI plus a few percent. And so you've got 50,000 plus any interest that's kind of accrued in theory over a period of time. So if you're saving over a period of 5 to 10 years, it may well be more than 50,000. That's the pre-tax amount. So really, it's a little bit less than that, about 42,500. So, you know, again, it's good if someone's already sort of well on their way to saving for a first home, or they're just about to get their first home deposit together. You know, it's not like you can get an extra amount of money out unless you've made voluntary contributions. But ultimately, that's how it's designed. That's where it landed. There's a lot of information about it. I do think it is worth considering, particularly for, I'll say, young people, but people at the start of their savings for their home journey. Trade-off is obviously if you don't end up buying a home, the money's in your super. That's good and bad. Like, it's locked away and you'll have it for retirement, but you can't get it out and go, oh, look, I'm not buying a home, but can I get those voluntary contributions out? Once they're in, the only time you can get it out is basically if there's a form with the ATO, you fill that out, you got to show proof of purchase, and then the money's released by the ATO. It's nothing to do with the super fund. So that's pretty much it. As I said, there's a lot of information there. It might be something that, you know, if you really want to dive into a bit deeper, the super specialist can certainly cover that off. Happy to take a question on that. Otherwise, enjoy the rest of your afternoon. And sign up for the Instagram page. Thanks, Ange. All right. Thank you, everyone. I'm going to end the meeting there. Bye.